Hello, folks. It is Friday, June 30th. It's about 1 o'clock on the East Coast of the United States. We're going to take a quick look at interest rates. We've had several of the talking heads babbling at us this week about interest rates and their expectation for interest rates. I've titled this video, Will Interest Rates Go Down? And of course, my answer and my bias is no, they're not going down. They're going up for a lot longer and a lot higher than most people are expecting. And a reasonable question to ask, and I found myself asking myself this question just this morning, why am I focused on interest rates? Well, I see interest rates as the central pillar of the financial markets. And so in the global debt collapse that we're currently in the midst of, interest rates are the key and basically the driving factor, the controller, the regulator, affecting the speed at which that collapse occurs. And so anyway, these on this slide, these are some of the factors that I thought of as I was asking myself, why am I focused on interest rates? Well, first of all, it's the size of the bond market versus the stock market. And so we can see here, so 40 trillion, and this is just talking about the US. So we're not talking about Europe or any other area of the world. We're only talking about the US. 40 trillion in bonds versus 20 trillion in the equity markets. So size of the bond markets relative to anything else. And, it's like, my thing is precious metals. Precious metals aren't even a blip on the scale when you're talking about the bond and the stock markets. Rising interest rates affect the prices in US dollars of precious metals. Higher rates tend to mean a higher US dollar. The dollar strengthens as we raise interest rates, and both of those factors have a tendency to push the price of precious metals lower. Rising interest rates also put downward pressure on real estate values. And of course, we're seeing indications of that. We've got real estate operators walking away from their properties and their loans. Several instances of that in San Francisco at this point. I think we've had 2 office buildings and 1 retail shopping mall where the operators are just, turning in their keys. Remember that jingle mail where you mail your keys to your mortgage lender? So now we're getting jingle mail on commercial real estate. And I would also point out that each default on commercial real estate makes the next default that much more likely. It's a building trend. Interesting thing to keep in mind when you're thinking about commercial real estate, those mortgages tend to be short-term and interest only. And so, every 3 to 5 years, the owners, the controllers of the real estate need to refinance their loans. And of course, we've gone in the last 3 to 5 years, we've gone from 0% essentially to now we're at 5%, or 7%, depending on miscellaneous factors that affect the price on a commercial real estate loan. So rising interest rates put downward pressure on stocks. Obviously, they drive the value of bonds lower, the prices on bonds lower. As interest rates rise, the value on a bond drops. And then those two factors together, lower real estate prices and lower stock prices, jeopardize institutional investors. And in particular, so I'm talking about mostly thinking about retirement funds, pension funds, like big pension funds like CalPERS. They're invested in commercial real estate, CMBS, commercial mortgage-backed securities. So basically the loans on commercial real estate. Obviously, they got stock investments. And so we haven't seen yet these institutional investors in the news, but in my opinion, we will. So anyway, these are just some of the factors that make me focus on interest rates. Here's this. This is Christine Lagarde talking about higher interest rates. Tackle persistent inflation. And of course, if you've heard me talk about interest rates, the whole inflation thing, that's BS. They're not trying to fight inflation. If they were serious about fighting inflation, they'd put interest rates above the rate of inflation. So we'd have at least 7% interest rates. And if we're realistic about where inflation's at right now, it's at least 12% here in the United States. And so we'd have to put interest rates higher than 12%. And imagine what that would do to stocks and real estate and precious metals, etc. So anyway, this fight against inflation just gives them a good cover story to keep raising interest rates. And they're talking about this 2% target, that they're going to get inflation back to 2%. We aren't going to, this is Brian stating his opinion, we aren't going back to 2% inflation rates. Inflation and interest rates are higher for longer. Just plan on it. And here's Powell talking again about, this was yesterday, U.S. rate hikes ahead. I think his actual language is saying a slackening in the pace of increases. But notice he's not saying a stop in increases, much less a pivot in increases. He's just talking about slowing down the rate of increase. And that just reminded me, the increases that we've had so far have been the fastest rate of interest rate increases ever. So serious increase in interest rates, significant change in interest rate environment. And so anyway, the talking heads have come out this week. They've told us that they're planning on higher interest rates, determined to fight inflation. And so based on Lagarde and Powell this week, we can expect, or it would be reasonable to expect, interest rate hikes from both the ECB and the U.S. Fed in July. Now let's run through some charts real quick. This is my favorite chart. It's been it's been inside this box for a little while. But I'm having to raise the box higher again to encompass this month's increase in rates. And as I've said before, in my opinion, this 1 year, the yield on the 1 year bill in the monthly time frame lets us know when there are bad things happening in our economy. Global financial crisis, big vertical move. Big scary plunge, March of 2020, big vertical move. And then, of course, this is just a huge, incredible vertical move in interest rates. And in my opinion, in hindsight, assuming that we have a future, in hindsight, we will be labeling this vertical move as the global debt collapse that was triggered by Evergrande defaulting back in December of 2021. And of course, this is occurring at the end of the 40-year downtrend in interest rates, where we ended up with basically 0% interest or even negative interest rates. So not terribly surprising that 40-year bubble blew up and did so dramatically. So here's the yield on the 1 year in the weekly time frame, and we can see that for the last 5 weeks, it was holding steady. Basically, if you want to think of it that way, running into inflation from this prior, or running into resistance from this prior peak, and now this week has broken above that level and done so solidly. This isn't a tentative breakout. This is a solid breakout above that level. Interest rates headed higher. And basically, this is the market pricing in July increases. The Fed's going to increase in July. The market's adjusting to that expectation. MACD in bull mode on buy signal, energy very elevated. So conditions, based on the chart analysis, conditions suggest higher rates. Yield on the 2-year and the weekly time frame, MACD in bull mode on buy signal, energy elevated. Again, big move higher this week. Have not broken above this prior peak yet. As I've noticed in the past, this is a megaphone pattern, or potentially a megaphone pattern, which is not a good thing in financial markets. Tends to lead to a breakdown, which would suggest lower interest rates. But of course, that's not my expectation at all. And there's no, I can draw all kinds of lines on charts. Doesn't mean anything in particular is going to happen. Yield on the 5-year and the weekly time frame, big move this week, still below the prior peak. MACD on a buy signal in bull mode, energy elevated. 10-year in the weekly, big move this week, finding support along both the 40 and 10-week moving averages. MACD in bull mode on buy signal, energy very elevated. 30-year is flatter than the other instruments, and so in the longer time frame, we're not seeing the as rapid increase in interest rates. MACD is in bull mode, but currently on a sell signal. Energy is elevated. We got a little bit of a bump this week, higher support again on the 10 and 40-week moving averages. If we look at interest rates on mortgages, 30-year fixed going to cost you 7.1, or on a jumbo 7.2. And of course, these rates are quoted for the most part for single family house and excellent credit. And so if you talking about condos, multi-unit properties, you don't have excellent credit, etc., you're going to pay more. You're going to pay a higher rate than that. That's all I've got in this video, and I will talk to you soon. Have a fantastic weekend. If I don't do another video, enjoy the 4th of July holiday. It's an interesting time to be alive, and I'll talk to you soon.